Hello and welcome to our webcast. Moth Adams is pleased that you joined us for today's webcast, Adopting the Current Expected Credit Losses Standard. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce our Moth Adams presenters, Chalak, Partner, and Colleen Gazer, Manager. Their bios and contact information are located in your console if you would like more information. Now, I'd like to turn the floor over to Colleen to get the presentation started. Colleen.
Thank you, Danielle. Before we get started, I did want to do a quick introduction of myself. Like Danielle said, my bio is available in the contents, but I have been working with Moth Adams for a few years now, but overall in public accounting for approaching 10 years now, and I focus primarily in the not-for-profit and higher education space. And with that, I'll hand it over to Ali as well.
Hi, good morning or good afternoon, depending on where you are. Chalak here. I'm audit partner. Throughout my career, I've spent my time in the not-for-profit and higher ed sector, specifically with micro lenders. So I'm really excited to be with you all today to talk about CECL and how it will impact your organization. With that said, what the presentation will go through the background of what CECL is and why the changes. Then we're going to go through an overview of the standard and then talk about some approaches that you could take to implement this. Then we're going to discuss some financial statement disclosures under CECL. If you do have any questions, as mentioned, please ask us through the Q&A chat. With that said, I'll turn it over to Danielle to go through our first polling question.
Thank you, Ali. All right, everybody, here's our first poll. How familiar are you with topic 326 credit losses? A, very familiar, already implemented. B, somewhat familiar, attended some training. C, I've heard of it. D, what is topic 326? So we'll allow just under a minute here for everybody to respond. To respond, please click the button next to the answer that you choose and hit Submit. If you can't see the Submit button, please enlarge the slide area until it is visible. Wonderful. We'll leave this up just a few more seconds. and the results.
Yeah, and this is, I would have expected to see this results, a mix of, somewhat familiar, I have heard of it, most of CECL really impacts our financial institutions, credit unions, and those types of institutions and organizations. If we do have a loan program of some sort, this is where CECL will impact us. Okay. With that said, here's our learning objectives. We're going to analyze, what the upcoming or the existing gap requires under CECL, how that'll impact your organization, and then talk about really what considerations to take when you're implementing this along with the financial statement disclosures. And one thing to note here, and the theme here is really looking at, working with your auditors, working with your accountants, to ensure that not only you've properly implemented this, but then whether or not it's material to the financial statements, and always consider materiality in the users of the financials when you're looking at a new accounting standard and the implementation of that. With that said, to understand, what CECL is about, we have to look at the legacy gap. So under an old gap or the legacy gap, the allowance for loan loss was calculated based on your historical loss rates. You would add a layer of Q&E factors, basically qualitative and environmental factors on top of it, but most of it really related to historical loss rates. And if you had TDRs, troubled debt, restructured loans, or impaired loans, the allowance would be calculated differently. So you could potentially have multiple methodologies of calculating your allowance for your loan portfolio. And really, CECL really is trying to streamline that. And if we kind of consider what happened back in 2008 through 2010 with the mortgage crisis, what happened with certain financial institutions was that regulators and auditors felt that the allowance was inadequate for the risks associated with the portfolio, and also when we were looking back during those times, there wasn't any in the guidance. There wasn't any standards regarding forward-looking or what your expected losses would be. So really, CECL is trying to also take into consideration a forward-looking measure as well. So let's go through the overview of the standard. So it is principle-based. What we need to do is look at what we would expect the losses to be over the lifetime of the loan. So, with, programmatic loans or with student loans, we're not, the life of those loans could be anywhere between a couple of years to 10 years. It's not very similar to the financial institutions world where they have loans going out to 30 years, but we need on day one, basically, of the loan origination, we need to predict what the losses will be over the contractual life. And that's important to know, and that's the biggest difference. Remember, it's a point in time, and it is an estimate, so there is judgment that is involved. So there will be a lot of discussions, not only internally, but with your auditors about, the judgment, the estimates that you are using, and whether or not those are reasonable. And this standard does not apply to loans that are held at fair value. I really like this slide here because it kind of encapsulates what the heart of the guidance is. So what we do is we look at the past performance of our loans. We look at the historical losses, right, under the new CECL model. We do that. We look at our current conditions, which includes micro and macro factors. But then there's this forward-looking or this future forecast element we need to do, right? In certain instances, you may not have the historical data to predict what those future losses would be. There's certainly external data that you can use. And also there are service providers that would help you with that forward looking. But the standard encompasses these three aspects, but then really the focus is on the future forecast and the future losses. And this slide goes through the legacy gap and the current gap relating to the allowance for credit losses. And as you could see here under the previous guidance, it was under the incurred loss model. You had, as I mentioned earlier, impairment models or multiple models for impaired loans. And then the important takeaway here is that under the old model, no reserve was required if there was no indications of loss. However, under the new CECL, an allowance for credit losses is required. Now, it may not be significant to your financial statements, but that is something that you need to consider. And then also, lastly, under the previous guidance, it was historically based on, the model was based on historical experiences, and now it's the future forward-looking model. So what is in scope for CECL? We have trade receivables or receivables that follows under topic 606. Those are exchange or revenue in a exchange transaction. Financial receivables, programmatic loans, loan commitments, those are the off-balance sheet credit exposure. So for example, if you're a micro lender and you offer a line of credit, it's on the undrawn portion of that line, trade receivables, and then also lease interest. So all of these are in scope under the CECL model. And for most of us, it's probably the programmatic loans, trade receivables or student loans that we're really looking at. So what's not in scope is, as I mentioned earlier, our financial assets that are held at fair value, promises to give or contribution receivables. Those are not in scope. If there are any loans between common control entities, that would be scoped out of the standards. And then also receivables that are arising from the leasing standards or 842. And then some loans that are under the employee benefit plans. But for you all to know, anything that is considered contribution receivable is scoped out of the standard, as I think that's more prevalent here. All right, we're going to go to our second polling question. Danielle, do you mind taking us through this?
Absolutely. Everybody, we are at poll number 2. Based on the overview, what impact do you think CECL will have on your organization? A, significant impact. Many of the in-scope items applied to my organization. B, somewhat significant impact. A few accounts are in scope and material. C, minimal impact. Not many accounts are in scope, and many of them are immaterial. And for those of you that were having a little bit of issue seeing the last poll, just a reminder to refresh your screens. If that's not working, please exit out of the webcast and rejoin us, and that should fix the issue. As a reminder, if you'd like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Okay, and I will forward us on to the results.
And this is what I would expect to, the majority of us, it would have very minimal impact because, either you don't have any trade receivables or you don't have any programmatic loans or any types of loans. So that's very similar, that's what I would expect. And then for those of you where it's somewhat significant, I would say, work with your auditors, get an understanding, of which methodology or which methodology to use to implement CECL, and we'll talk about those methodologies shortly, and then how much disclosures you need in the financial statements relating to this standard. And we'll be discussing that in greater detail in the upcoming slides. So when is all of this effective? It's effective for fiscal years beginning after December 15, 2022. So if you're a calendar year end, that's your for the 2023 fiscal year, and then also any fiscal year ends starting after beginning 7/1/2023. Most of what I've seen is you have various options of how to implement the standard, very similar to what we've seen with the leasing standards and some other standards. You could do the modified retrospective approach or the cumulative effect adjustment to net assets at the beginning of the first reporting period, in which the guidance was effective. I've typically seen that where you're the cumulative effect versus doing the modified retrospective approach there. But it is up to management how they want to implement this through the transition date. With that said, I'm going to turn it over to Colleen to go through the mechanics of implementing the standards. Colleen?
Thanks, Ollie. All right, as Ollie mentioned, the next slide section will be going over, now that we have the basics of CECL, how do we implement this and things to consider as you're implementing this. One of the key changes that will be a focus for CECL is no longer just focusing on historical information, but taking into consideration the current and future terms and factors that might impact credit losses. So with that, you might hear the term life of loans concept if you happen to be an organization that has a programmatic lending arm. But really, it's just measuring the potential losses that could be experienced over the life of any asset that you have that falls within the scope of CECL. With that, it takes a pretty deep dive into your organization's assets on hand to understand what's in scope here, what impacts these assets that I have on hand, and what information do I have available to me that I could utilize to get a better understanding of current conditions and forecasts. I think the difficult piece here is forecasting over the life of an asset. I understand that many organizations might have long-term programmatic loans, items that maybe mature in 5 years, 10 years. And it's difficult to build in a forecast that is over the life of that loan, per se. And with that, CECL really relies on reasonable and supportable forecasts. So we'll dive into that. How do we build a reasonable and supportable forecast? What should my organization consider as we're building out the CECL model here? Just a couple items that for those of you that do have loans, it's important to consider prepayments. And then just in general, for many organizations, consider the environment that you're operating in, the assets that you have on hand, or receivables, and who you work with. Those will be important to understand kind of the layout of your portfolio and better hone in on which criteria you can focus on to build your forecasts. All right. So reasonable and supportable forecasts. On the left side here, we have the guidance directly from the accounting standard update. But a summary of this is in previous years and kind of what is probably most common for most of you is utilizing historical information to estimate credit losses. With that, with CECL, one of the important items is incorporating an element of forecasting. So a lot of you will start with historical information and then have to identify factors that will impact current conditions or future conditions of your assets. There is no prescribed methodology or required information that you need to use for your forecast. This is entirely up to management to take a look at the assets you have on hand and what's in scope and determine what might impact you in the future, what will impact credit losses for these assets that will need to be considered. And a few examples that are listed on the left here could be unemployment rates, property values, delinquency. All of these can point to the credit quality of the financial assets that you have on hand. All right. So just highlighting a few key changes here. As you're adopting CECL, there are a few questions that it's important to ask yourself and for management to consider. One, how do I forecast this? How long should I forecast this? Is it possible for me to apply a forecast for the loans that I have coming due in 10 years from now? That's where it's important to implement your reasonable and supportable forecast timeline. It is not the expectation for you to predict every future event that occurs over the next 10 years. just utilizing whatever information you have on hand that is reliable and reasonably available for you to utilize. With that, for those of you that have long-term, say programmatic loans, that is something to consider of the term. There are pros and cons to each of having a longer forecast versus a shorter forecast. So, for example, a longer forecast might be able to pick up anticipated economic swings. However, when you have a longer forecast, that also lends to things just don't go according to how you might have predicted. So there might be more volatility in your calculation and less precision about what's happening currently. While the shorter forecast might capture the volatility of what's happening now. You're not trying to predict an event that might impact credit losses 5 years from now. However, you might miss anticipated cycle changes if you're taking into consideration economic swings and things like that. All right. So we went over reasonable and supportable forecasts of how do I predict the losses over the life of my loan or the life of my asset. Another key item that needs to be considered as you're implementing CECL is pooling considerations. So CECL requires that you measure expected credit losses on a collective basis where similar risk characteristics exist. So it's important that you take a look at the accounts in scope and take a look at the individual items that are in that account to determine, are there similar risk characteristics that apply to multiple of my assets on hand here? Is there trends that I could identify and pool these assets by? With that being said, of course, there's always going to be an outlier here or there where if there is a receivable or loan that has unique risks that doesn't quite fit into any of the pools, it should be pulled out and evaluated individually. With that said, as you're applying CECL, remember to pull it out of the pool. Don't double count it in there and make sure it's evaluated separately with a reasonable basis of why does this not fit into the rest of the pool here. All right. So pooling could be done by a number of factors. It's, taking a look at which credit quality indicators or risks might impact the items in scope here. Is there something that is a risk factor that overlays multiple of my assets on hand that fall under the scope of CECL? And this could be credit risk scores. If your organization is a programmatic lender and has risk ratings that you assign to your loans, that might be something that you use to pool your assets on. Collection experience. It really depends. This is completely up to management to determine which one or multiple should be applied to your pools. That really gives a good indicator of the credit quality and can be used to bifurcate your portfolio. All right. So with that, those are, I'd say, two key important factors that come with CECL, and it's better to start taking a look at your what's scoped in early, sooner rather than later, so you can start gathering up the information, considering these credit quality indicators, and how to build out this model. With that, as far as where to start for this, it's taking a look at what's in scope. As Ollie mentioned, this is applicable for most of you as of December 31st, 2023 or June 30th, 2024. However, you do need to take a look at accounts that were in scope at the beginning of the year, and don't forget to consider those as well. It's not just what's outstanding at year end, but also the beginning. And understanding what's in scope and what's out of scope. What is the impact to my organization? And once you have a listing of accounts that are in scope, take a look at what's making up those accounts. As I mentioned, the pooling considerations, are there common risk factors that should be used for pooling? Is there anything that is unique in nature? I would say it's also important that for organizations that might not have a huge amount of accounts in scope, consider materiality here and consider the number of transactions or receivables that are sitting in there. If it's a small number where pooling might not make sense, and it's not a material impact, it doesn't have to be, you could revert back to just evaluating individually. With that, CECL requires, starting with historical loss data. So taking a look at what you have on hand, whether that's internal data, or if you don't have a good historical loss data on hand, considering outside factors that are reasonably available or outside information. And then considering what's a reasonable and supportable forecast, what conditions might impact the collectability of these assets, what's the reasonable forecast? Can I reasonably predict what might impact these assets in a year? And being able to identify, well, if I can't predict what's going to happen past 5 years, maybe I can revert back to historical data. So it's just a lot of this is collecting information, and whether it's internal or external sources. And then from there are multiple methodologies that could be used to adopt CECL. While there is the overlying factors of applying pooling and then having your reasonable and supportable forecasts, there are methodologies that can be used that we'll go over in the next couple slides that it can be used to implement this. All right. So just a few estimation approaches. We'll just talk high level about some of these. They're the most common ones that we've seen. Again, management, it's up to management's decision to select one that most accurately reflects the estimated losses, and should be considering what what information is available on hand. All right, the first one is the discounted cash flow, and this is a valuation that is used to estimate the value of a financial asset based on expected future cash flows. With calculating the discounted cash flow, it's typical that you'll use an effective interest rate, whether that is implicit in, say, a loan agreement, or a contractual interest rate that is specifically named out. Or it might not be available, and it just has to be a discount rate or interest rate that you believe is reasonable to be used to assess the future cash flows. Once you've calculated the discounted cash flow, the allowance for credit losses will be the difference between the amortized cost and the present value of the expected cash flow. Now, with that being said, the benefit for discounted cash flow is that it already implicitly, it includes the life of loan aspect, where you're looking at cash flows over the life of your assets. So that is a benefit where if you have maybe longer term assets, 10-year, 15-year programmatic loans, this might be a method for you to incorporate your future forecasting. If it's for an organization that doesn't have very long-term receivables or assets on hand, this might be, I would call this more of the complex method for implementing this, but it does have its benefits in that it's taking into account the life of the asset. For the roll rate, this is a method that is using historical information about the movement of accounts from one delinquency stage to another, and using that to predict the amount of current financial assets in each category that will migrate to the next. So with that, this is really starting with your historical information. So you should be utilizing what you've had in previous years, considering if previous year information, you might need to adjust it. I say this because looking at historical information, you'll probably be looking at COVID-19 impacts. And for some of you, that might have had a huge impact on your organization and your assets and credit quality. So it's important too, when you're taking into consideration historical information, consider if it needs to be adjusted for, well, COVID-19 was somewhat of an outlier. Maybe we need to adjust that information. And with that, you're using the historical information to understand where do we think the delinquency stages will land for the current assets we have on hand. Once you have the total migrations calculated, you can add that together to estimate the credit losses over the life of your assets. the next methodology is probability of default. And this is kind of a three-factor calculation. And with this, the probability of default method considers three variables. One, probability of default, the exposure risk, and the loss given default rate. For the probability of default, the organization should determine the threshold of what default is. And an example of this is if you define a default as maybe someone who is 90 days past due. From there, you're calculating the probability that the asset will default. This can be done using historical information as well, adjusted for current and future forecasting. And then we go into the loss given default. When the loan defaults, what percentage do we think is going to be charged off? This can also start with historical information of typically, the items that are 90 days past due, we're charging off maybe 50% of that balance that's outstanding. And then the last piece is estimating the exposure risk. What's the outstanding obligation at the time of default? What do I think that is? So if we take this into a calculation and say, as of year end, approximately 5% of the assets in scope will default. They'll reach 90 days past due. From there, we think 50% of the asset will need to be written off, and overall exposure is around $1 million. You would multiply these factors by each other, and your allowance would land at maybe $25,000. So this is another way to take a look and consider taking historical information and modifying it to come up with a probability calculation. And the next one, which I think will be, the most familiar, and probably the easiest way for a lot of organizations to implement CECL, is just an aging schedule. When you take a look at items in scope, it might be a trade receivable account, but a lot of organizations will take a look at the credit quality based on an aging schedule. So this might bucket your receivables into, or your assets into, 0 to 30 days past due, 30 to 60, 60 to 90, so have you. And from there, taking a look at historical information and saying, well, typically 5% of items, 90 days past due are written off, 2% for the ones that are 60 to 90, and applying a reasonable percentage that could be based on historical information and adjusted for future or current circumstances. So again, this is something that is, I would assume most organizations are able to run and track an aging schedule. They have historical information that they can utilize. How you create a forecast and consider current options is up to you. But this one is, I would say, probably the easiest for implementation purposes. Okay. And with that takes into consideration, I think, the most common implementation methods. There are a few caveats related to some other accounts, like trade accounts receivable. If your organization has assets under Topic 606, something to consider is just, one, if there's implicit price concessions, that's something that will need to be considered in addition to your CECL model. And, with the guidance that accounts receivable is recorded when it's probable that the amount will be collected. I know this can kind of conflict with the idea that CECL is asking you to predict losses over the life of the asset. So with that, even if as you record the accounts receivable, your trade AR on day one, you do still need to consider the probability of loss over the life of that trade receivable, even if it's a remote possibility that a loss will occur. All right. Another kind of caveat with CECL is financial assets secured by collateral. I don't expect this to be, impacting most of the organizations. I rarely see nonprofit organizations that have financial assets secured by collateral, but nevertheless, this is another item that CECL does touch on and provides guidance on. There is a CECL-related practical expedient for collateral-dependent assets. This permits an organization to estimate credit losses based on the fair value of collateral less cost to sell. So when you're taking a look at the collateral, this can be applied if the borrower is experiencing any financial difficulty, and if you assume that repayment is going to have to be funded through the sale of the collateral. So if foreclosure is probable, if it's, say a house, then you can use the fair value of the collateral to calculate the allowance for credit losses. So that could be used to kind of net the credit loss there. With that being said, you do need to have the fair value of the collateral as of the date of reporting. So that's a little caveat to keep in mind. So with that, with calculating the allowance, it would be calculating the difference between the fair value of the collateral as of the balance sheet date or the statement of financial position date and the amortized cost basis of the asset. That would be how you're calculating your allowance for credit loss. All right. All right. And with that, just something to consider, and I think this is important for beyond collateral provisions, but also just in general for CECL. I just mentioned that when you're going to use collateral maintenance provisions and adopt that practical expedient, you need to consider the collateral value as of each reporting date. So if you're planning on foreclosing and holding an asset for a long period of time, you might have to get that fair value measurement updated as you report. But in general, I think this is important for any CECL topic that we're talking about here, is just considering the information that you have on hand and how it'll be available in the future. So you might not want to fair value this information in the future. And just like any other CECL aspect, you want to make sure that information that you're going to utilize is reasonably available and it doesn't cause undue costs to the organization. So I don't think CECL is asking you to go out and gather data as beyond a reasonable expectation. It's just using what you have to create a clear quality, credit quality picture. All right. And with that, I'll hand it off to Danielle briefly to take us through our polling question.
Thank you, Colleen. We are at poll question number 3. Which implementation approach are you considering? A, discounted cash flow. B, probability of default. C, aging schedule. D, something else. As Ollie mentioned earlier, you do have the option to submit questions for the presenters in the Q&A window. We have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. And we'll keep the poll up just for a few more moments to get a few more responses from our audience. And the results.
All right. Yeah, I think this tracks pretty well with kind of the expectation of aging schedule is generally the most common method and has the most available information. But then with different assets on hand, people have different methods for applying it and what best fits management's expectations here. So, all right. So with that, now that we've covered some of the key pieces of CECL and how to adopt that and some of the estimation methodologies that can be utilized, we'll talk about what to expect for financial statement disclosures. All right, so just taking a look at the statement of financial position, one of the requirements for CECL is if you have an asset that is in scope and the impact of CECL is material, you present it specifically on the statement of financial position. So if you have your receivable, you'll also include a description that it'll be net of allowance for credit losses of X amount. So it's specifically available there. With that, I don't think this impacts many nonprofit organizations, but for off-balance sheet credit exposures, if you happen to be an organization that has a line of credit available, you'll want to also recognize the estimate of expected credit losses as a liability of the statement of financial position. And the liability is reduced when the instrument expires, results in recognition of a financial asset, or is otherwise settled. So just keeping that in mind, that off-balance sheet credit exposures also need to be presented separately. We have a summary of the new disclosures required. I think just for the first year of implementation, that is going to be another phase of this. Not only are you changing your policies, your description of policies and methodologies for your CECL disclosure, but you also have to disclose some information about how you adopted the standard. What was the impact? What methodology did you use to adopt that? So in addition to new disclosure requirements and enhanced requirements there will be some first year implementation disclosures as well that you'll need to put in. I think the most important piece of this is the enhanced disclosure requirement of CECL. The goal here is to really help your readers and users of the financial statements understand the credit risk that your organization is facing. So this requires a description of policies and methodologies for adopting CECL. You'll want to be clear about the reasonable and supportable forecasts that you've adopted, credit quality indicators that you might have chosen, reversion methodologies that were applied. So if you have a reasonable and supportable forecast that you've disclosed, at what point do you revert back to just using historical data because the future forecast is no longer reasonable or supportable? For those of you that have a lending arm at your organization, if there's any non-accrual loans with no related allowance, you'll want to disclose the amortized cost basis of such loans. And I will say if you are an organization that has a lending arm, your disclosures regarding impaired loans and TDRs will change as the concept of impaired loans is gone. All right. So just a summary of things that you want to start looking at and collecting information for the year of adoption. Accounting policies and your policy elections. This will typically be in your disclosures in Note 1 or Note 2 of the financial statements, wherever you have your significant accounting policies. You'll want to describe what credit quality information did you choose that you think will impact your assets on hand. What's the status of past due? What do you call a past due, and what's the total dollar amount? The total amount of the allowance for credit losses, and then a few other items just depending on how material this is and what type of assets you have on hand. If you don't offer any off-balance sheet credit exposures, a lot of this will just not be applicable to the organization. All right. So just a summary of the accounting policies, and this again will be your Note 1 or Note 2, wherever you account for your significant accounting policies in the financial statements. Expect that your disclosure surrounding allowance will expand significantly. The goal here is to really describe the methodology that you applied. Why did management think that's reasonable? What are the credit quality indicators? With that, if you have non-accrual loans or things like that, you'll want to disclose non-accrual policies. You'll want to disclose the policy for determining past due or delinquency status. If that is something that you've recognized as a credit quality indicator, you'll want to disclose kind of the risk that your organization is facing for past due and delinquency. And the policy for recognizing write-offs. This might be that an organization will write off a balance as soon as it's 90 days past due or 120 days past due. So you'll want to disclose that. If you're considering recoveries, that's not necessarily, I think, specifically needs to be disclosed in your accounting policies, but it is good if you're going to talk about how you recognize write-offs. It's good to look at the other side of this of how do you recognize recoveries if your organization has a policy for that. All right. Just a couple items here that talk about the policy elections that come along with CECL. These are a few just to keep in mind depending on the types of assets that fall under the scope of topic 326 for you. This might be if you have interest rates attached to your, if you're using the discounted cash flow, you want to disclose the interest rates and the timing of expected cash flows. So that's an item that a policy you can elect. You could also make an election to not measure allowance for credit losses on accrued interest receivable if you have that type of asset. And then there's also a policy election that accrued interest may be written off by reversing interest income or recognizing credit loss expense, or a combination of both. So these might not apply to anything that you have on your statement of financial position. If so, you can write it off. It's not applicable. It's just something to keep in mind if you happen to have a pretty material impact from CECL. All right. As I mentioned, in addition to expanding your existing disclosures regarding allowance for the users to truly understand the credit quality and the risks impacting your organization for the assets that are in scope, there are disclosures that are required in the year of adoption. This might be a separate paragraph where you're describing a new accounting standard adoption, or it could be embedded in just your significant accounting policies, but it'll want to describe the nature of the change in accounting principle. You'll want to specifically note that you've adopted CECL, the methodology that you've utilized to adopt it, whether it's modified retrospective, and then also calling out the effect of the adoption on any specific line items in the statement of financial position, if it's material, and the cumulative effect on the change in net assets or other components of equity on the statement of financial position. So this should be, there are examples of this that exist out there for how to disclose the adoption of a new accounting standard. And really, if this is not material, doesn't have a material impact, that could be one of the disclosures in there too, where we have adopted this. However, it did not result in a material impact on the financial statements and merely resulted in enhanced disclosures. All right. And with that, one of the last items is just disclosing credit quality information. We had touched on a previous slide that this is completely up to management to take a look at their portfolio of what can I utilize to really predict the credit quality of the assets that fall in scope here. You'll want to disclose that for each type of financing receivable that you have that falls under topic 326, a description of the quality indicator, the credit quality indicators. You'll want to present the amortized cost basis by credit quality indicators. So you'll need to be able to kind of bifurcate and split up your portfolio by your credit quality information. And for each quality indicator, the date or range of dates in which the information was last updated. Just to back it up for a little bit, for organizations that really just have trade receivables, I will note that trade receivables that are due in 1 year or less are exempt from certain disclosures. Make sure you're taking a look at what you need to and what you don't need to disclose. So for example, if your trade receivables are due in 1 year or less, you do not need to disclose past due status, credit quality, or non-accrual. So with that might actually help you save some time, and you might be able to pass some of these required disclosures that CECL requires. All right, and with that, I'll hand it over to Ali for the next section.
Thank you, Colleen. So as we're going through these disclosures, right, we have to think about what's material to our financials. And what we're going through when we're looking at these disclosures, we're giving you the required disclosures, and you may pass on it from an organization standpoint based on your users and materiality. But, one other thing we need to do, as Colleen mentioned, is when we have these credit quality indicators, we basically segmentize our portfolio. And what we'll need to do is disclose the unpaid principal balance by segments. And And not only that, but discuss how the expected loss rates was developed, our accounting policy associated with it, the risk associated with each of these segments, and the factors that influence CECL. And you kind of carry these segments or these the portfolio segments forward through your financial statements. And one other thing we'll need to do is with the allowance is create a roll forward by these portfolio segments. So we start out with the beginning balances. We talk about the changes, the significant changes, including the write-offs and things to that nature. So this will really give your users insight to how you view your portfolios, the risks associated with your portfolios, and how you're managing those risks, along with how does the allowance for credit losses, how are you recording that by portfolio segments. And this is what I was talking about earlier. You are required to have a roll forward of the allowance for credit losses by these portfolio segments, starting with beginning balances, your current provisions, any write-offs, and then any recoveries to come to your ending balance. Now, maybe sometimes you cannot do this based on your loan types, and then there's other methodologies of breaking out and disclosing your loan portfolios. But that I would suggest talking with your auditors relating to that. I know Colleen touched on past due listings, but what we also have to do is disclose the past due statuses of our loans and of our trade receivables, if applicable. And basically, it's current 0 to 30, 30 to 60, 90, and then 120 and plus. So that is something that we would need to disclose in the financial statements. So we're coming up on our fourth polling question. Danielle, can I turn it over to you?
Absolutely. Thank you, Ali. So final polling question of the day, how prepared is your organization to adopt CECL? A, very prepared. We have historical data available and know the current and future circumstances which could impact credit losses. B, somewhat prepared. We have some data but need to research a bit more. C, still working on gathering the data we need. For those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email tomorrow, along with a recording of the webcast. And once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. We'll allow just a few more seconds to get a few more responses to our final polling question of the day. And the results.
Perfect. Yeah, and if we have a loan portfolio arm, sometimes we don't have that historical information to provide the future expected losses. But what I would suggest is first having a discussion with your auditors, and then also your lending department or group, and the AR team to see what information you have available and gather that, and then start implementing the CECL model. Okay. With that said, I think I'm not going to spend a whole lot of time here, but with collateral dependent financial assets, if there are any loans that are collaterally dependent, there are some additional disclosures associated with it. Specifically, what the asset is, the type of the asset, and some of the qualitative disclosures. But once again, with most of the programmatic lending I've seen, they're pretty much unsecured. But if you do have any collateral dependent loans, making sure that you have the required disclosures there. And the off-balance sheet, this is an area, and we brought this up multiple times because this is an area that typically slips through the cracks. But if you do have off-balance sheet credit exposure, making sure you properly disclose that in your financials. We typically don't think about that until the 11th hour, so something to put on the forefront when we're looking at the CECL model and the implementation of the guidance. So other considerations, I think if we do, financial institutions, banks, credit unions, there's a lot of public data for them to use, and they have a lot of internal data to use. But, in the not-for-profit sector, if you're a micro lender or you have a lending program or programmatic lending, there's not a whole lot of external data. So you'll probably need to get creative here using internal data and what's available out there for you to use to implement CECL. But I think the takeaway here is working with your auditors, and there's definitely vendors out there to help with the CECL implementation as well. But I feel like based on the polling questions, the majority of you, as this has somewhat of impact, I think you could get through this with internally available data. All right. With that said, Danielle, I'll turn it over to you for any final thoughts and comments.
Thank you, Ali. Thank you, Ali and Colleen, for a great presentation today. To our audience, if you do have any further questions or comments, please reach out to us as we would be happy to continue the conversation. You can drop a note in the Q&A window or reach out to Ali or Colleen directly. Their contact information is in your console. Also, I'd like to draw your attention to the image in the upper right-hand corner of your console. Click this to be taken to more information on our upcoming Uniform Guidance webcast, which will be July 11th. Hopefully you can join us for that one as well. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. Finally, here's a link to an online survey for today's presentation. Thank you for joining our webcast. We hope you'll join us again next time. Take care, everybody.